Well, hello everyone, and welcome to Fidelity's Soundbites. My name is Paul Taylor, and I'm Head of Investments here in Australia. With me today, we have the Dream Team. We have James Abela, who's the Portfolio Manager for the Australian and Global Future Leaders Fund, as well as Casey McLean, the Portfolio Manager for the Australian High Conviction Fund. And our topic here at the end of the year is the outlook for 2025. But before we get into all the really interesting stuff about 2025, I did want to talk about one little competition we're running at the end of the year. Now, we're all very excited here today because it's our Christmas party. It's the Fidelity Christmas party. Now, we have a theme for the Christmas party, and that theme is iconic movie characters. And you'll see from the photo that covers the podcast that we're all dressed up. And if you can correctly identify the character each of us is playing and send that prediction in and get it correct, the first correct entry will win a $100 Westfield voucher. Please email your answers to podcastaustralia@fil.com. Good luck with that. Hopefully it should be pretty easy. Hi guys, great to be here. Welcome. Before we get into things, do you want to give a hint as to who your character is?
All right, here we go. Summer rally, it happened so fast. I met a stock, crazy for me. Problem was on a 50 PE.
Yeah, hi guys, great to be here with the Wolf Pack.
Yes, okay. So a couple of good hints there. Hopefully, with my introduction as well, you've got a pretty good idea of exactly who we are. Now, let's have a little look back at your predictions, all of our predictions for last year. I was surprised at how good we were. So I predicted the Broncos would win the premiership, the Brisbane Lions would win the flag, and the Brisbane Female Lions would also win. Obviously, the Broncos I didn't get, unfortunately, but the Brisbane Lions, we got both. So that I was pretty happy with that. That was a good result. How did you think you went, James?
I said that inflation would come down, and it had come down very quickly, actually. We're up at 7s and 8s back then, and now it's around that 3 level. So it did actually happen. And it's always hard when you're at like very strong inflation levels. People feel like it's going to go on forever. But it did happen, and we could see leads, I guess, from the US and Europe that it was coming down. So you're happy that one has come off. So Casey?
Yeah, well, I luckily took the other side of Paul's trade and said New South Wales would win the State of Origin, so quite successful there. And the other one was that there'd be a few surprises in the elections that were held last year, where I think that one came off as well. We saw big swings away from all the incumbents right around the world. So,
well, you do seem to like to take the other side of my trades as well. I'm not quite sure what that's about, but anyway. So review of 24. So tech continued its great rally. Banks hit new heights. Cost of living didn't, it's there and it does impact, it's impacting the consumer in different parts of society. Okay. But overall, actually, the consumer still sort of hung in there pretty well. So I thought that was an interesting outcome for 24. There's a little, I would also say, as we went through the year, we maybe a normalization of markets, if I can put it that way. We have been very macro-driven last couple of years, 22, 23, very macro-driven as interest rates went up. Then we saw a bit of sort of normalization. And, I guess, well, at least my view going forward is we're going to be much more stock-specific. We have started to be that through 24, but it's going to definitely come into 25. Did you guys see any major differences in 24?
Well, no, I think that's right. I mean, we had some pretty violent bouts of volatility along the way, though. Remember back in August, the Japanese carry trade unwind, right. which was a pretty violent incident, and some thought the end of the bull market, which didn't sort of pan out. But
it went and then it just disappeared as quick as it arrived.
But I think that's an ongoing theme. Volatility is here to stay. There's more uncertainty in the global macro environment, and that's not something that's going away anyway soon.
Okay. Yeah, I'd say, look, tech was a big thing. In small caps, it was just the dominant theme of the year. We had tech software, we had health tech, we had consumer tech, and tech just dominated. All the high performers have all been really technology, and the index is up quite significantly during the year, up 22% for the year to November. But yeah, tech, healthcare, and financials all did incredibly well. So it was definitely, like I said, very macro-driven from the fear of free money going back a few years to money so expensive we're going to get nowhere, to now it's normalized. But it's very euphoric in mid-caps and small caps.
So you just need to put tech behind your name. Is that what you're saying? So all
Pretty
we
much.
need is like a resources tech, and that we could get the resources going as well. It's like that reminds me of the TMT bubble when every company renamed themselves .com.
Yes.
And got a massive valuation
Rerating.
uplift on the back of that. So now if we look a little bit forward as well, and in Australia, the big one is always sort of banks, financials against resources. And what we saw in 24 was really the banks and financials in general perform strongly, and resources is still very much the forgotten about sector, cheap sector. It seems to be very related to, a negative focus on China and China's impact on resource. But I guess maybe let's just open up, James, in the small cap world. It's a little bit different for you, but maybe I might start with Casey, and you can still give your view on resources as well. Yep. Casey, as we go into 25, how do you see banks, financials against the resources?
Yeah, I think with not only the banks and resources, but I think across the market with this sort of ongoing volatility and also a bit of a change in the macro regime to global sort of interest rate cutting regime, that's often a trigger for rotation amongst sectors. Leadership in the market can change, and I think banks are pretty ripe for that. Given my view is that the fundamentals are really disconnected from valuations there. You can see returns are in structural decline for the banks. Mortgage returns are in line with the cost of capital, yet competition is still increasing. Business banking gets you better returns, but that's also a new source of competition. And then if we do have interest rate cuts, that's another sort of headwind for bank earnings. And yet, they're trading on record high multiples, whether you look, absolute terms or relative to the market. And so I don't think the risk reward looks great for the banks. And I guess one way to sort of telegraph that is if you compare CBA versus CSL. Both stocks happen to be trading on about 26 times PE for FY25. For CBA, that's about 75% above its long-term average. For CSL, it's bang in line with their average, but the growth rates and returns are very different. For CBA, the market's looking for about 2% growth over the next couple of years at a 13% ROE, but CSL, the market's looking for 15% growth, high teens growth over the next couple of years at an 18% ROE. So I think that shows you the big disconnect between the fundamentals and valuations in the banks.
That's really interesting on the banks. Like I said, resources is probably the cheapest sector, but it doesn't feel like, what's the catalyst to get it going?
Yeah, no, I think that's right. And if you look historically, it's rarely been a time where banks and resources have both outperformed in the Australian market. But I think there is some potential catalysts down the track for the resources sector. I mean, China's policy pivot over the last few months is pretty meaningful. They've executed on the monetary policy side. The fiscal policy side, they still haven't fired those bullets yet. But I think they are in the barrel. They're ready to go. They're just waiting for Trump to come in and see how bad the tariffs are there. And I think the market's reaction to that in the resources sectors, probably the initial reaction when tariffs are imposed is that's bad for resources. It's bad for global trade, bad for growth, and resources sell off. But the secondary reaction that could be is that China will stimulate to offset these tariffs, which is good for commodities. So I think, with that, and I think it's a structural change in China's policy stance, the risk reward looks much better to me in resources than it does in the banks.
Okay, well that sounds more positive for 25. James, do you have your view on resources for 25?
Yeah, so just looking back, the index was up 44% for the year in small caps compared to the index at 22. So huge performance, and that's really driven by the confidence, like similar to, I guess, Casey's comments about the banks. Financials confidence as a sector was very high as we've gone from recession to euphoria.
Yep.
The attitude towards risk had changed, so those multiples really expanded, but net wealth and hub multiples expanded enormously, and the structural growth in those businesses are still very, very strong. So it's 15, 25% growth for these sort of names over the next few years, and they've delivered that over the past. But resources is the opposite. Yes, very much a bear market, except for gold and copper is still quite bullish. But resources did quite poorly. It was, one of the worst performing sectors, only up 7% for the year. But that's really driven by gold and copper. Everything else not doing a lot. So yeah, I'm definitely looking at that. I've been, looking at buying strong free cash flow yields that are very attractive valuations in resources. For example, a little bit of iron ore and other things. But it is very attractive and sentiment is very poor. So it is a very good opportunity. And I've seen this before in small caps with late 2016, resources and energy, the market was very underweight. Those sectors was very much a bear market, and those indexes went up nearly 100% in the 12 months after that, late 2016. So they can have a rally, usually based on stimulus or some kind of greater confidence in the universe, but they can move a lot, resources and energy names, if there is that commodity confidence come through.
Yeah, it's almost like a pinch point, isn't it? Really, when that pinch point happens, they can
and you're starting
really
to
move.
see, obviously, large caps with Anglo, takeovers in small caps with De Grey.
Yeah.
So you're getting the industry saying, okay, there's valuation here.
And that's the
Rio.
first.
And you even had Rio taking over Arcadium Lithium.
Exactly,
as well.
yeah. So it's all starting. You've got gold, you've got Rio. So I think, it's a good signal that the industry sees value.
Yeah.
So it's a good signal for
And I think that once the industry sees, and I'd agree. I mean, I think resources are looking really good value. At the moment, it's hard to see that. And maybe M&A is the catalyst.
Yeah, it can be.
It can be China, it can be an M&A.
Yeah.
The one thing I'd pull out on financials, though, as well, is I actually still think insurance looks pretty good for 25. I think premiums are strong. They've got strong cash flow. They're actually paying out good dividends. And there's going to be a lot of capital returns, I think, pretty much from the whole sector, which actually creates a capital discipline as well. So I would personally separate insurance, which looks pretty good. So now let's move on to the tech sector, and I'm going to start with James. This is your this is your little baby.
Tech.
Can tech continue to do what it's done in 24 in the last few years? Are we going to see more of that in 25?
25 should be good for tech. I think that is the potential surprise in mid-caps and smalls because the growth is actually there. Although multiples have rallied hard, in many cases, the growth is still there for these stocks. And the thing is, when you use the word tech in Aussie mids and smalls, it goes across so many sectors. So you've got the traditional software tech, so software businesses. Then you've got consumer tech, which is REA car sales. Then you've got health tech, such as Pro Medicus. Then you've got your fintech, which is your hubs and your net wealth. So there's a lot of tech generally, and all of those stocks have done incredibly well in 24, and all of them have got very strong outlooks in 25. Right. So it's hard to see that not doing well as a class. So yeah, I think although tech was up 50% for the year as a benchmark for the year of 24, it should do well in 25.
Yeah. Casey, any other additional views?
No, I broadly agree. I think a lot of these companies have big potential markets, with structural growth opportunities. You've probably got, an environment of falling interest rates, which is good for long duration growth companies.
That's a good point.
And a lot of them earn their revenue in US dollars as well, which could be good. And finally, I think it's hard to put tariffs on software. So I'm not saying they're immune, but they think there's less danger than on physical goods for geopolitical risk in software.
Yeah, the US dollar has definitely been the consensus trade, and it's been strong, isn't it? And it doesn't look like it's going to stop soon. The only thing I would add to that commentary is, the one missing area, I think, in economies, in Australia's economy and all around the world is productivity. And we really have been missing productivity. And when you think about, that's what needs to happen, I think, for us to keep going. And I look to the tech sector really for that productivity growth.
Yep.
And I think when there's limited productivity, if a tech company can help other companies improve their productivity, that product will sell well. So I would say
it's a huge
thing.
theme. I mean, that's the thing, and I said that last year. So I think when you got high inflation, very tight labour markets, high cost of debt, and governments and corporations trying to reduce costs just everywhere they can. Technology is very often the answer to that. Yeah. So for the world, for corporates, families, individuals, governments, countries, technology it will be used more and more.
Yep.
So I do think it is very much, a huge theme.
Yep. Okay, so let's jump on to the next really interesting area, which is the consumer. And as I said, The consumer's really held up, I guess, much better than originally thought. But, with interest rates are staying high for a while, there still is a cost of living. There does definitely seem to be a two-speed maybe movement in the consumer. Casey, how do you see the consumer in 25?
I think you're right. The probably the buzzwords around consumer has been resilient or robust, and they've enjoyed some pretty strong tailwinds over the last few years with migration running at record levels, government giving out a lot of free money in stimulus checks, and then a lot of people were still on these very low fixed rate home loans if you go back a couple of years ago. But I see a lot of these sort of tailwinds turning into headwinds as well. I think there's potential that interest rates in Australia stay higher for longer. I think inflation is stickier. I think those excess savings have really dwindled. You can see the savings rates at zero for Australia, close to it. And it's really only the people that are over 55 years that are still seeing their savings balances grow. And the younger you get, the quicker you're seeing your savings balances decline. And migration looks likely to be curtailed, become an election issue as well. And I think, labour market is loosening at the margin. You still see job ads are declining as well. So there is potential for that to go up. So, I think it's a fairly tough sort of environment. I mean, the offset is that you've had tax cuts, but in recent data, it doesn't seem to have been a huge stimulus to retail sales. And in fact, I think if you break it down in its most granular level and you look at the retail volumes per capita, so you're taking out inflation, you're taking out migration, you saw in the September quarter, it was down 0.1%, which is the 9th consecutive quarter that measure has been down.
Right. Mm-hmm.
Yeah. So it's been good in the aggregate, but if you look at it on a personal level, it hasn't been that great.
Yeah. I guess immigration has probably really saved us in Australia as well onto that point, isn't it? At an individual level, it's been tough, but we've had a lot of immigration, which has been very positive for the economy.
Absolutely.
James, now you do global as well as Australia. Do you
Correct.
see much difference between the Australian consumer and the global consumer? How do you view the consumer in 25?
They're similar. I mean, the Aussie consumer was very patchy, and so was the US consumer. But the US consumer and consumer stocks did relatively well. But again, it's the same as Australia. It's just very patchy. So ones that were winning share did well. Ones that had leading products that captured the consumer's imagination, or they become very desirable products, those ones held up a lot better than mid-range and low-range product areas. And I'm definitely more positive on Aussie stocks that have a global edge to them. So like a Lavisa, for example, or a market leader like Temple & Webster has done well. Even JB Hi-Fi did quite well performance-wise and fundamentally as well. But the core consumer that is more mid to low end has really struggled.
Right.
You've had a lot of announced bankruptcies this year in consumer in Australia. And I do think the consumer is, on average, doing it pretty tough, which is what Casey's sort of saying, and the data supports it as well. So it's not very bullish, but I think the pockets of stocks that performed well are either structural winners or they've managed things incredibly well this year. And they've surprised on the upside and they've got re-rated on that basis. So global and Aussie, actually very similar trends in consumer.
So maybe 25 is the year it gets a little bit tougher for the consumer, but there's still good opportunities if you're selective. Where those, there's still structural stories.
Yeah, correct.
Which I think is important. Okay, 24 versus 25. When we started 24, I think people were, we were very bullish, which also 24 turned out to be a great year as well. As we sit here at the start of 25, are we just as bullish? Are we now moderate? Because valuation is, I guess valuation's moved up a bit as well in that bullish 24. How do you view the market in 25 and put valuation into that?
Yeah, go Casey.
Well, for Australia, I think you're right, Paul. Valuation is high. It's well above sort of long run averages. So for the market to perform again as strongly as it did in 24, you really need earnings to come through. We've been in an earnings downgrade for about 18 months now, and there is some signs that it's starting to bottom out. The second derivative has turned, but we really need to see the global macro pick up. I mean, the global PMI is a huge driver of Australian earnings across the board, across the whole market. But, I think there's some good signs that we are in for that sort of soft landing and unlikely to see a recession, even though some recession indicators have been triggered over the year, the yield curve and the SARM rule. But when I look at most sort of indicators across the market, we're in a much better position than in previous cycles when those indicators have turned. So I think we can see earnings growth or earnings upgrades come through in Australia, I think particularly in some of the more cyclical sectors, which is another segment of the market you can see rotation into, I think, over the course of 25. But I think in general, it's going to be a volatile environment as well. There's so many risks that still overhang us with new political administrations in all around the world. You have wars raging that could stop and affect commodity markets like Russia, Ukraine. There's just a lot of risks around. So I think the path is up, but it could be a volatile path.
Well, the second derivative is always that's a good point. I mean, often markets will follow the second derivative, and the second derivative is really acceleration or deceleration, not just growth. And I think that's always a good lead indicator. James, your views?
I think it should be a good year. There is growth, which is good, but I agree with Casey. There's going to be a lot of volatility. And we've seen it already in quality stocks and momentum stocks that disappoint. They're off 30, 40%, very quickly.
Right.
So those sectors that have done incredibly well and stocks that have done incredibly well need to really deliver. But the index at 22 times PE already is a pretty high level. So it's setting, a very high expectation paradigm in investors' mindset going into 2025. So any volatility or any disappointment, there's going to be challenge overall. It should be a decent sort of, year. We've had 20% returns for a couple of years as well, led by the S&P, but also in mids and smalls. So that sets up, a pretty challenging to do that 3 years in a row is pretty challenging. Yeah. So I think it will be volatile, but good. But yes, it all depends on the earnings, and valuations are going to be dependent on delivery.
Okay, so that all sounds maybe cautiously optimistic.
Yes.
Yeah, I think that's fair.
Which is, I'd probably agree with that as well. Okay, now this is what everybody's been waiting for. We did quite well in 24. Let's see how we're going to go in 25, and we'll recap this when we come back to you next year. James, what's a key prediction for 25?
I'll say tech performs very well as a sector. Okay. So I think that's a given. The thing is that tech, fintech, health tech, med tech, that's the question. But we'll just have to keep it on to tech. I think we'll do well, is my view for 25.
I like it. Casey?
Well, I'm going to double down on last year's bold prediction, and New South Wales will win State of Origin again.
You've got to lose sooner or later.
It's the start of a dynasty, I think.
Oh, goodness.
But in terms of markets, I think in Australia, a key event is going to be the federal election sometime in the first half. And my bold prediction is we're going to have a hung parliament. We're going to have a minority government. I think if overseas elections are anything to go by, there's going to be a big swing away from the incumbent Labor government, really driven by those cost of living pressures that have hit home, and the government is often the scapegoat for that. But at the same time, I think there's potential for either or both of the Greens and the Teals, the Independents, to win a lot more seats as well. So I think you could be in a situation where we've got a minority government, which is not great for the growth outlook, because it means it could be hard to put through fiscal stimulus, fiscal spending. And if we look at the recent period of growth in Australia, it's really been driven by government spending and immigration. And actually the private sector has been pretty weak. Right. It's been basically in recession. So it's a risk to growth if they can't get that spending through.
Excellent. Okay, Casey, I like it. Except for the part about New South Wales winning State of Origin. All else, yeah. And for myself, I'm going to go down the rugby union track for my prediction this year. We've got a big British and Irish Lions are touring Australia in 25. I'm actually going to predict the Wallabies win across the 3 matches. So now that is a big prediction. I think Joe Schmidt has got the Wallabies back on track. And we had a much improved performance in Europe just recently. So that's my big sporting prediction. In terms of markets, I actually think, we've been the IPO market has been closed now for a while. I actually think we could see that reopening in 2025. So, new companies coming to the market. I think we could also see a bit more merger and acquisition activity. I think led out of the US, maybe some of the potentially regulatory changes in the US could lead to more M&A, which will then lead out around the world as well. So more M&A, more a renewed IPO market, and in a solid performance in 2025. So I think that's our predictions. Let's see how we go. And we'll, fingers crossed. I think that's exactly right. Now, just before we sign off, I just want to remind everybody about the competition. We're off to our Christmas party. So guess the 3 iconic movie characters we have dressed up as. The first with a correct answer, and send those to the email podcastaustralia@fil.com. First one will get a $100 Westfield voucher. Actually, we wanted to take the opportunity to wish everyone a very Merry Christmas and an even better 2025 and, importantly, good returns in 2025. And thank you for listening. If you'd like what you heard today, please subscribe to the podcast on your favourite platform. Or if you want more information, please head to the Fidelity website at fidelity.com.au. See you in 25.
Thank you.
This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.